And Jeff, now it's time to welcome one of your favorite guests that never disappoints here on the Income Generation. Of course, that's Harry Dent, author of 0 Hour and editor of the Economy and Markets newsletter, available for free at harrydent.com. Harry, as usual, great to have you here with us on the Income Generation.
Yeah, nice to be back.
Harry, we've had some volatility recently. I can feel the breeze of volatility starting to affect the markets. And so we're looking for a correction at some point here shortly between now and the end of September, maybe October. Is it going to be COVID that causes the correction, or is it going to be the Fed's expansionary policies?
You know, I think it's really just that we've stretched this market so far with so much stimulus. And of course, COVID gave governments around the world, and especially in the U.S., the excuse to really step up, not just with massively stronger monetary stimulus after 12 or 13 years of that, but also very substantial fiscal and infrastructure stimulus, which is still being debated and to be fully passed in Congress. But we're talking about upwards of 65% of GDP in stimulus, monetary and fiscal, just since late 2019 and the repo crisis right before COVID and since COVID. So COVID is the whole reason for this overreaction and stimulus. But I've been warning the fundamentals, because, you know, my demographics measure where the consumer's really at in their natural spending cycles, and we're at the lowest points between 2020 and 23 we're going to see. So the markets are in a huge disconnect with the economy. It's all because of stimulus. And, you know, you just keep stretching this thing until it starts to pop and something goes wrong, and then people lose confidence. Now, COVID is starting to come back. This new variant is a little more contagious and potentially lethal and stuff. So you're seeing some lockdowns, like, you know, even Australia, where I do a lot of presentations, they've had nothing burger for this, but they're still very cautious. So I think that may be part of it. But I think this rally's just wearing out. How many times can people refinance their home or trade up to a little nicer house or buy a vacation house, even though they don't need one? I just sold one, by the way, and very happy because I realized I didn't really need that second house.
Well, those are all great points, Harry, but why has the bond market been acting so weird, and why is it mystifying everybody with the recent decline in the 10-year?
Yeah, this one, okay. The stock market's been doing this forever, and all the stimulus and ultra low interest rates. But I think the bond market, I was reading an article that said that a lot of these, you know, funds and stuff that are investing in equities and stuff have to have some kind of reserves and something or collateral, and they tend to put it in treasury bonds. So more the stock market goes up, it means there's certain areas where professional and institutional investors have to hedge that with treasury bonds, and they're buying them for no good reason. And you're right, there's nothing more out of whack right now than the 10-year treasury, that's saying like inflation looks like it's zero for the coming years, when inflation is sitting and continues to rise at 5% and more. And nobody thinks it's going to be 5% 2, 3, 4 years from now. But even Janet Yellen had to come out and say, look, this is not going to stop anytime soon. And my view is there's only one thing that's going to stop this short-term inflation, and that's a recession. And the recession is not good for corporate bonds, and it's terrible for stocks.
So, Harry, could it be a traditional flight to quality that's happening right now? I mean, after all, and I'm going to make a caveat here so everybody knows that we're recording this show 2 weeks before it actually airs. But I know that you had said 4,400, 4,500 would be the peak on the S&P. It got to about 4,393, almost 4,400, and then it seemed that the 10-year yield went down. So could it just be a flight to quality that maybe the market is no longer trying to make all three of us look silly?
I don't think it's that. Now, I'm talking about a channel there, and as time goes on, as long as the market hasn't broken that channel, it'll have to break about 4,200 on the S&P 500, which we got close to but did not break. That channel keeps going up. So that's target more like 4,600 now. And it'll just keep going up until the market breaks that upward momentum, which it hasn't done yet. So I don't think it's a flight to quality. I think investors I mean, this has been going on forever. Everybody knows somehow in the back of your mind you don't get something for nothing. And how can you live on an economy where government just constantly print money, which is, out of nowhere, and think that can cause long-term growth, which it can. But it is a short-term stimulus. And so I don't think people are going flight to quality. I think people have learned you buy the stock market on dips, and until something's proven otherwise, hey, COVID was an exception. And COVID, yes, caused the steepest crash, fastest we've seen in 2 months in a while, but it came right back because governments used it as an excuse to stimulate harder than ever. So I don't think people are running to quality. I do think that, like this article says, a lot of leveraged vehicles for investing in stocks need a certain amount of collateral. And I think these treasury bonds are being bought for that reason, because again, they have nothing to do with the inflation outlook. Sure. Inflation is not subsiding, as I said, and it is more at 5%. Yeah. And these treasury bonds are at 1.3% or less, acting like inflation would be zero, because you have to earn a little return over inflation.
Oh, you're right.
Inflation is zero.
There seems to be a disconnect. The only time there isn't a disconnect is if the inflation turns out to be extremely, extremely transitory. Otherwise, anything longer term, you're right, huge disconnect between that and the bond market. Harry Dent, thanks again for being here with us on The Income Generation.
Sure.